Today, I am ably assisted by Jonathan Lowe, who is a right-hand man of sorts for me, and he's going to share the presentation. So we're going to wait till the end of my talk to entertain any questions or comments you may have on what we're going to speak to, and so we're gonna be going about maybe about 30 minutes or so, and then we'll open it up. So what you see before you on the screen is a quote whereby this really well-known author of Morgan Housel, and if any of you do listen to any podcasts relating to investments, and I think he also talks about general life matters. He's really a worthwhile podcast person to listen to, or you can buy some of his books. He has a new one coming out, but the one I pulled a couple of quotes on is from The Psychology of Money. So I'm just going to make reference to two of the three quotes that I had referenced in the presentation, whereby the first one says that the most important part of every plan is planning on your plan, not going to plan. And I would say this decade has been a great example of so much not going to plan because of all the twists and turns, and we're going to talk about that in a moment. The second comment is with respect to economic uncertainty, whereby he says that there's rarely more or less economic uncertainty. And all we seem to hear about is economic uncertainty. When it comes to the media, in TV, if you ever listen to the talking heads on BNN or CNBC and newspapers and radio, they're always talking about uncertainty. And so in my 4 decades of managing money, that's all I ever hear about as well. I never hear any commentators say there's no uncertainty and therefore go and jump in and invest. And that's why you're in capable hands with Robert Luft and his group, whereby, they're going to guide you through periods where we have a lot of uncertainty. And I'd say that the last couple of years has been represented of that. So if we slide back to the cover page, Elvis Pease, what you see is that the title of the talk is going back to the reference of how the 20s have been a very unusual period. We kind of call it the rolling 20s, but, perhaps a better name could have been the roller coaster 20s, because we've had a lot of ups and downs and twists and turns that were very much unexpected. I mean, think about it. We started this decade with the closure of the global economy with COVID coming around. And in relatively quick order, only 10 months to come up with a vaccine. Normally, it takes 10 years. So from closure of the economy to the vaccine to the reopening of the economy, which unleashed demand that resulted in product shortages. So we've also gone from supply channel problems to higher prices as end market demand couldn't be met. We've gone from low interest rates to high interest rates, and to this aspect that the high interest rate environment, at least it's high compared to where we've been recently, was perhaps going to bring the economy to a grinding halt. Well, it did not bring the economy to a grinding halt. And if we go forward 2 slides there, Elvis, what you see is some evidence of which I speak, whereby in the third quarter, which is the most recent quarter for which we have GDP data, and we're looking at U.S. Measurement of economic growth. And we just released this week that the third quarter was revised up from 4.9% growth to 5.2% growth. Now, the economists had started the quarter at 0. And so what we're looking at is economists that have had to revise up their forecasts because they've been overly conservative. In fact, what I like to say is that we've been 3 months away from a recession for more than a year and a half now, because it was a year and a half that we started to raise rates. Now, when it comes to the economy, I know that I don't know. And I also know that economists don't know. And lastly, I know that economists don't know that they don't know. And no institution employs more economists than the central bank in the US. The Federal Reserve has 400 PhD economists. And so what did they forecast for this year? Well, what the next slide shows is that they had forecast a slowing down of the economy with the solid blue line. As you look at the screen on the left, that's growth for this year. And they did that because interest rates were going up. Now, as interest rates were going up, what we see is that typically the economy slows down. But interest rates were coming from such a low level that it didn't really, impact the economy to any significant degree. And so I think that there's a good chance that we can avoid a recession. And even if we get a recession, it will be a very mild one at that. And it's not going to affect the opportunity set that we invest in. So very hard to predict the economy. Now, I, as an investor in the stock markets around the world, pay attention to the stock market and what fuels the stock market. And what the next slide shows of us is the aspect that the correlation of the stock market is such that when earnings are going up, and that would be the blue line, then the stock market's going up. The correlation is over 90%, 0.95. And so earnings are in the process of going back up. And that's what the next slide shows, whereby we've already had a slowdown in corporate profits. We've had the slowdown in corporate profits for the S&P and really for the major stock markets around the world, whereby this year, through the first half of this year, the year-over-year gain was less. In other words, it was U.S. companies and corporate companies around the world were being challenged. What you see on the left side is that we're finally going above zero. That's the light blue bar. So that means that we're reversing from corporate profits being under pressure to a recovery. And what we're looking at on the right side of the screen is corporate profits, once they recover, that they typically continue to go up. And that's very favorable for the stock market, which has been going up this year, to add to its gains. So we are constructive on the market going up next year. Now, what you see is in 2020, that was a very quick rebound on corporate profits. Remember that the global economy was shut down. So this time around, we are expecting that corporate profits are going to recover. But with the economy that is at a slower pace now, perhaps it's not going to be as robust as that, but it's still moving in the right direction. So a lot of people have been concerned about interest rates. And what the next slide shows is the real rate of interest. What is the real rate of interest? If you take the 10-year nominal bond yield on the US government bonds, subtract out inflation, and you get the real yield. I've been in this camp of suggesting that interest rates had been too low for too long. And I believe having near zero interest rates, and in fact, in Europe and elsewhere, we had negative interest rates, not only on a real basis adjusted for inflation, but even nominal. At one point, we had in the world some $17 trillion at a negative interest rate. Now, imagine investing in a bond where you buy a bond at $1,000 and you're going to get back $990 a year hence. Well, that's what it's like when you invest at a real negative interest rate. So I welcome a more normal environment. And I believe that we are now in a more normal environment. So the aspect of interest rates being higher does not disturb me. Notice on the graph that this goes back all the way to the early 80s. Now in the 90s, and perhaps it may be easier to see or not, depending on your screen there, what we would see is that interest rates on a real basis in the 90s were higher than they were today. And what did we experience in the 90s? One of the best decades ever for economic growth. In the 90s, it was one of the best decades for investing in the stock market. Now, I don't know that this decade will be as healthy as that, but what we had said on our title page is that this decade may end in a roaring fashion because we have some technology breakthroughs that can fuel the market higher. And my own opinion is that we're going to get used to higher interest rates. So why didn't high interest rates take a bite out of the economy in the US? I think in Canada is a slightly different story. Because if we go back up 2 slides there, Elvis, what we see on this bar graph, next one, please, is the aspect of, we're going to keep going on the next one. Sorry, I didn't get the right slide there. The aspect of interest rates impacting the homeowner that has a mortgage. In the US, only 15% of mortgages are variable. So 85% have been fixed. What this means and what this translates into is that the average mortgage rate in the US is about 3.6%. Today's interest rates, the 30-year mortgage rate, because they have 30-year mortgages in the US, is double that. If you glance your eye on the left side of the screen and move over 2 bars, what you're looking at is Canada. So Canada, 1 in 3 households have a variable rate. So the pinch in terms of higher interest cost is without question going to be felt much more here than it is in the US. In fact, I guess this week, we had one of the banks that reported, the Bank of Nova Scotia, who had increased their provision for loan losses. So I'm expecting that the higher interest rate environment here is going to be more impactful in a negative way than it is in the U.S. But make no mistake about it, higher interest rates are going to be a drag on the economy. Anybody that's looking to buy a house, they have to pay more interest. Anybody that's looking to buy a car, higher interest costs. So I do expect a slowing down of economic growth. But perhaps offsetting some of this slowdown in the more cyclical area is what we see coming from government expenditures. So if we go to the next slide, what we're looking at is this one just shows that consumers haven't been that delinquent on their loans, so no imbalance there. Next one, please. Employment is keeping consumer in very good shape. We'll be getting the employment figures once again. We've had almost 2 years in the U.S. of very low unemployment rates at less than 4%, and so we've seen a little bit of a slowdown in employment growth. But as long as you get employment growth, and we are going to get employment growth, albeit at a slower pace, then that's going to keep consumers, spending. I do believe that this Christmas and holiday period is going to be a little slower than years past, but we're still going to get a good aspect from that perspective. Next slide, please. And what I mentioned earlier is that the more cyclical parts of the economy perhaps are going to slow down. But look at government spending. This is true in the U.S. because we're looking at Washington and U.S. economic spending for fiscal stimulus that came from a number of programs. It's also true here in Ottawa. We just got a recent budget. So I think that whether it's Biden in Washington or Trudeau here in Ottawa, they can't help but help themselves in terms of continuing to spend. I don't think it's a responsible thing to do, but it without question will help the economy to stay on a firmer track. So what the next slide shows is the aspect that once interest rates are hit in terms of a pause of increases. Remember, we've been going up since March of last year. We've now hit the pause button for a couple of months in a row. I think that the next step could be a decline. But to the extent that we get some inflation number that may not be cooperative, it's possible that we get another rate hike. At this point, I'd rather doubt it. And so what does the stock market do when Bank of Canada or the Federal Reserve and central banks hit that pause button in terms of increasing interest rates? Well, what we see is in the past that the stock market 3, 6, 12 months later is higher. So I like to consider all factors as I decide on decisions that can give you a good experience within your portfolios, all kinds of considerations that are going to allow me to make more right decisions and wrong decisions. And so this is something that I think we have in terms of our favor, because more often than not, you can see the market is higher. It didn't go higher in 2000, but we have to remember that we had 9/11/01. It ended up that there was not really a delay on the economic recovery in the early 2000s, but then from 02 to 07, the market was up 100%. Now, when it comes to the stock market this year, on the next slide, what we're seeing is that it's been very narrow. What do we mean by that? It's been relatively few stocks that have pushed the stock market higher. The so-called Magnificent Seven. That would be Apple, Microsoft, Google, Amazon, Nvidia, Meta, or otherwise known as Facebook, as well as Tesla. These are the biggest companies in the U.S. stock market. At one point or another, we have owned these names, and you would want us to own them because they became the biggest companies because their share prices were going up. Now, some of them we haven't owned in a while, and so that would hurt us this year, because most of the stock market gain this year has come from these names. Because if you X them out from the stock market gain, we're looking at a low single-digit gain, and that would be true of an equal weight. In other words, cap weight allows the index to be calculated by giving more weight to the big companies, and obviously equal weight ranks them all equal, and that has been lagging. So the light blue line shows that these companies have been hyped up. And why do I say that? Because it shows the valuation. Now, the price to earnings ratio is an indication of the expensiveness of these stocks, and they've gone up. In fact, most of the gain this year of the Magnificent Seven has been fueled by the stocks going up much faster than earnings, which means they became more expensive. Earlier in the year, we only owned one of these companies, which is Amazon. In the summer months, we added Nvidia, because when it comes to Amazon, when it comes to Nvidia, these are the only two companies whose earnings are growing faster than the stock price is going up. In other words, these companies are not getting more expensive, as indicated on the right side, vis-a-vis the stocks being very expensive from a valuation perspective compared to the stock market. They're actually coming down. And so we do pay attention to that, because we do want to offer downside protection, because when you buy stocks that are perhaps overhyped, that have gone way up without the underlying fundamentals to justify that appreciation, that's when you could get yourself into trouble. We've seen this in the past. We saw it just last year. In fact, the Magnificent Seven were not so magnificent last year. In 2022, which we know was an awful year for the stock market and the bond market, what we had with the Magnificent Seven was an average drop of almost 50%. And so we protected in that environment because we didn't really own them, with the exception of Amazon through the whole year. And so this year, we're back to Nvidia, and we feel very comfortable. And where we feel very comfortable is in investing in themes whereby we think that this decade could end in a roaring fashion. And it may get rolling to that upside, sooner than we expect, because we have certain trends that are in place in the next slide that are as true today that they're going to be as true in the balance of this decade. So what are these trends? The trends towards reshoring, otherwise known as deglobalization. I mentioned at the onset that we've had some challenges on supply channel problems in meeting end market demand. So manufacturers are now moving facilities closer to their end markets, and we're seeing investment and opportunities from that. We know that there are some geographic areas whereby there's geopolitical risk, such as in Taiwan, that provides most of the world's semiconductors. So we're seeing semiconductor plants coming into North America, into Europe, into Japan, and that's going to lead to some opportunities. We're looking at the trend towards robotics and AI. We've had this theme in AI now for longer than a year. In fact, it was AI that accelerated the research and development that resulted in the vaccine being discovered in a record amount of time. In fact, it was 1 year ago today 1 year ago today. Hard to believe that ChatGPT, was released to the public at 4.5, and that was a breakthrough product that ended up with so much discussion and so much to read about and so many concerns. But we're focused more on the opportunities coming from AI, and we're going to talk about that here in a moment. We have the trend towards sustainability, whereby we're getting more electric vehicles, some hybrids, activity that's better for the environment. So sustainability is a factor that we consider. Again, these are considerations that are true today, and they're going to be true in the future. And if anything, they're going to accelerate. For example, in health and wellness, we have a breakthrough with treatment of diabetes and obesity with so-called GLP-1s as a drug group. And we'll touch on that here in a moment. But people are actually, eating better and exercising and dressing better. And what you see on the screen before you is a pair of On running shoes. As you heard from Elvis, I'm a big walker, and I think last year or this year, the year's almost over, averaging 13,000 steps. And the On running shoes are very comfortable. So I'm not sure if any of you have On running shoes, but if you don't have them, please go out and buy a pair and help me out, because we own shares in this company. We also own shares in ASIC. So if you're a runner, we own a Japanese name, because these are companies that are gaining market share. Now, people are feeling more comfortable to return to the hospital environment for elective surgeries. For the longest time, they were nervous. For the longest time, and this remains somewhat of a challenge, we have a shortage of healthcare workers, but that is improving. It's not perfect, but it's improving. So what you see is an image of the Dimishing system. This is a robotic surgery system that allows patients to have a faster recovery time, a more accurate surgery, and less time in the hospital because it's less invasive. And so Intuitive Surgical is a name that we own as a beneficiary of this trend. So in the next few minutes, I'm just going to touch on each of these trends to show you how we stack up with the evidence in terms of getting the odds on our side with solid fundamentals. That is to say that there's a good tailwind of growth. And when it comes to AI, the leader is Nvidia, because Nvidia does the semiconductor chips through the graphic processing units that allow the compute power that is allowing the translation of large language learning models, of generative AI, that results in a product like ChatGPT, so it could be a very useful experience. So there's a rush by the largest data vendors and database companies, whether it's Google and Apple and Microsoft and Amazon, to buy the Nvidia chips. In fact, China wanted to buy the Nvidia chips, but AI could also be used for military purposes. And so Biden put a restriction on Nvidia's most advanced chips being exported to China. But the demand is so strong that they told us on the recent earnings call that they're going to more than make up for any slowdown as a result of the restrictions in China. And even on China, they have a workaround. So what are we looking at? We're looking at data center revenues, which inflected in the second quarter, in the third quarter, and you can see how it's moving higher. Now, some of you may ask, how's this relevant to me as a consumer? So we have a couple of illustrations, and a couple of them are on the next slide. And what we're looking at is the ability to send a photograph to ChatGPT, and some areas for parking are very complex. And by the time you figure out, if you look on the left side of the screen, whether you can park in this spot or not, you probably got a ticket for no stopping. So send a picture to ChatGPT, and it says, yeah, you're good for an hour starting at 4 o'clock. So if you're like me, and I love foodie and my sushi and my sashimi, and you go to an Asian markets and things are in kanji, you can't read the label, I probably would buy both products. But what the right side shows of the screen is that it would identify through a picture, which is the soya sauce. So that's a useful consumer use of ChatGPT. But here's something that I used just this past 2 months ago when I was hiking in Croatia. And so what the next slide shows is a chat I had with ChatGPT. So I took a picture of the wine list, after a day of hiking, hot day, beautiful country, Croatia, by the way. Highly suggest that you go there. Friendly, good food. So, and the wine was delicious, except in Canada, it's not widely available. So on the right side of the screen, you see my discussion with ChatGPT. Can you make a recommendation? Well, I was happy it didn't recommend the most expensive bottle, and I actually did order that first recommendation. And what you'll notice if you take a closer glance at the screen is that almost every answer came back with, and it's available in a 0.75 liter bottle. Well, 99% of bottles are 0.75. So, there's still early days of the tweaks to get the response right. Now, Croatia is in the Adriatic, a lot of good seafood. So you can ask the ChatGPT, like I did in further discussion. Do you want something a little bit more floral or fruity or acidic? So then it would pick the right wine that may be suitable for you. So just an example of how ChatGPT is going to impact us all. And it's happening, in many, many areas. MIT scientists fed into their computer the antibiotic molecular structures of all found working antibiotics. And it narrowed down the field to a more narrow sample. And now, for these super bugs that are emerging, they came up with 2 new antibiotics. So in the field of healthcare, we're seeing that. And the healthcare AI moment really came with the discovery of the GLP-1s. Now, the GLP-1s are drugs that came up with initially by Novo Nordisk for people that may unfortunately suffer from diabetes type 2. Very effective treatment for that. And what this drug is also effective for is to reduce appetite, to have a more feeling of being full. And so it's also indicated for obesity. And obesity is a big problem around the world, especially in the US, where almost 40% of the population is technically obese. Another 30% are overweight. And so this drug is expected to be one of the biggest, most likely the biggest blockbuster drug, approaching $100 billion in sales. Right now, there's something like 1.5 million people on it, and that's on the way to 30 and possibly 40 million people. Right now, it's in the form of injectable only, and a lot of diabetes patients are used to administering a needle to themselves, but people that may want to lose weight are not so used to that, and so there's going to be an oral form, and Eli Lilly is in a portfolio, and we love to see, movements from the bottom left to the top right, because the revenue growth is tremendous, and there's also benefits from this drug that are indicated in a variety of aspects, from cardiovascular to aspects of orthopedics, because people lose weight, less pressure on the joints, even for Alzheimer's. And when it comes to Alzheimer's, Eli Lilly has a very promising drug that's in phase 3, and that looks promising to be introduced. So there's more than one breakthrough that's going to benefit Eli Lilly. Speaking of charts that move from the from the bottom left to the top right, we're looking at manufacturing here, whereby the manufacturing jobs are moving up. I mentioned the reshoring, deglobalization. Well, here's that in evidence today in terms of the spending. Is this pace going to continue? I kind of suspect not, but definitely it's an area that's offsetting, weakness in the economy, and that's why we like some of the more industrial oriented plays. Next graph, please. So I mentioned, companies looking to reshore in terms of moving their manufacturing capability closer to end market. And you can see in transcripts on the left where companies are mentioning this. U.S. manufacturing capacity, after being stagnant for a very long time, because we relied not only in the U.S., but also in Canada and other industrialized countries to move manufacturing to low-cost geographies like China. Now, it's going to take us a while to get off of that supply chain because we still rely on it. But without question, we're going to see more capability coming in end markets, in manufacturing closer to their end markets. And this is an evidence with these two slides. Next slide, please. So we're going to now transfer into the discussion of the portfolios in terms of the people, the philosophy, the process, and then Jonathan will be taking it over soon to talk about how we've negotiated the ups and downs of this decade to give you a good experience as you stay invested and hopefully are invested with us. And to the extent that you are, we appreciate that vote of confidence in our capabilities because we dedicate more and more resources to the portfolio by the team that you see before you, whereby a year ago we've added resources to the team. So the way we manage the portfolio is that there's 4 of us at our senior level that are generalists. We can talk about the economy, we can talk about trends in all the different sectors. And then on the bottom of the screen, we have the sector analysts. So they're covering all the various sectors, doing detailed work on the names that we own. We also have a quantitative team that helps us tailor output from our 20 people quantitative group that does extensive research using algorithms that will allow us to use inputs in narrowing in our focus in terms of which companies we want to pay more attention to. So what the next slide shows is, in essence, the philosophy which I have, which is to capture the market leaders in every cycle. And that's why I say I start every day with a white piece of paper. And the reason I do that is I jot down the symbols, and to the extent that I'm jotting down the symbols of the names that we own, I have to be willing to buy them each and every day because I want to fulfill this objective of capturing the market leaders in every cycle. And what I've noticed is that market leadership is seldomly the same from one cycle to the other, and it's always changing. So why does it change? There are 2 principal reasons why it changes. Number 1, based on innovation. Innovation whereby companies are introducing new products, dynamic new products and services, the likes of which that you and I are buying. And to the extent that we're buying these products or subscribing to these services, then the company does well as it sees revenue growth. And when that sales needle is moving in the right direction, a company will grab market share and it'll be rewarded in the stock market. The day that a company takes its eye off R&D dollars that's resulting in these new products and services, another company will come along, better product, better service, grab market share and be rewarded in the marketplace. The second factor in terms of leadership change from cycle to cycle has to do with the macroeconomic environment. Because a macroeconomic environment can give us either a headwind or a tailwind in terms of the opportunity set. 3.5 years ago, as the economy shut down, we sold our economic sensitive. I mentioned earlier that we bought Intuitive Surgical, the robotic surgery company. Well, we did own this stock in the beginning of 2020, but nobody was going to be going to the hospitals with COVID around, so we sold it because we didn't know how long it was going to last, and so the company was going to suffer. But now, we're back in the name, so you can see how the macroeconomic environment could lead to opportunities and also to challenges. So what makes a stock a buy each and every day? Well, the next 2 slides shows that we have an extensive list of metrics whereby, we're willing to own companies that have revenue growth. That's confirmation that the company's end markets are healthy. Again, making reference to the end markets that may be benefiting from a macroeconomic environment. But more importantly, it means that companies are truly delivering on the notion of innovation because the company's products and services are being bought. Now, earnings growth, as I mentioned earlier, important to the stock market, important to individual companies, but we are willing to accept companies that compromise their near-term profitability for long-term growth. We've owned Amazon for a very long time because Amazon continues to invest in its cloud services. AWS, Amazon Web Services, continues to invest in fulfillment, whereby it's got a big moat. And so this is a company that has had periods of low profitability, but we think that now they're at the point of reaping the benefit. So we start with a very large universe of companies and boil it down to a concentrated, high conviction portfolio, which in the case of our global portfolio is between 25 and 40 names. In the case of our U.S. large cap mandate, that's based on the namesake of our firm, American Growth Fund, AGF, that one is between 30 and 50 names. So if the stocks are a buy each and every day and we decide to sell, what makes a stock a sell? Well, what the next slide shows is there's 4 reasons why we sell. We sell whereby we're willing to take profits. We've done that in the past, and Jonathan's going to talk about this here in a moment. We will sell in a deterioration of fundamentals. You know, a competitor has a better product. Maybe there's a management change. Maybe there's M&A that's not working out. So any number of reasons that's fundamentally based. It also could be based on companies, not non-company specific factors. For example, you know, if there's policy initiatives that's going to inhibit profitability of certain companies, and we know that sometimes, you know, Washington does meddle in these sorts of things. And we're happy to have a resource on the ground with Greg Vallier. So he covers the political situation for us in terms of regulatory and emerging trends there. And he's been following politics based out of Washington, D.C. for many decades. And we hear from him on our daily call. We will also sell based on switching to a better opportunity. And then last but not least, we will sell on a 20% stop loss. Not only 20% from our costs, but also when a company drops 20% from its high. Now, we do not do this when there's a systemic sell-off in the market. In other words, it's an automatic review, but not an automatic sell. Because last year, the market went down over 27% from its high to its low. You know, back in 2020, when the stock market ran into trouble on COVID, it was down over 35%. So again, you know, we're using this more diligently when the stocks go down in isolation. So when it comes to our global select portfolio that's coming up here next, it's a best idea portfolio. Why do we say that? Because when you think about a global portfolio, it's investing right around the world. So we're going to pick our best stocks from a U.S. large cap mandate, from a U.S. small mid cap mandate. And what you see before you is a number of names that we own that are U.S. and non-U.S. in terms of companies that are delivering great results. And what these companies have in common is that they have fundamental momentum. And when it comes to these companies, they're always changing. And seldomly are we holding on to companies for a prolonged period of time because leadership, as I mentioned earlier, is always changing. The only name that's in the portfolio today that was in the portfolio at the end of last year, a year ago, 2 years ago, 3 years ago, is Amazon. We've owned that one for a very long time, and we're glad that we've stuck through the ups and downs on that one because it's definitely, you know, helped us to help you make progress when it comes to investing in our particular mandate. There's Intuitive Surgical that I mentioned. Nvidia's there. We see an energy name, Boston Scientific, with their cardiology franchise. So at this point, I'm gonna hand it over to Jonathan, who's going to walk you through the geographic weights of our portfolio, as well as the sector weights, and then segue into, you know, how we made some rotation in terms of geographically, sector-wise, and helping to participate on the upside and protect on the downside. Jonathan?
Thanks, Tony. So what you see on this slide is our geographic weights in the AGF Global Select portfolio. What I would say is that what we don't have is sort of a country allocation framework. We're trying to pick the best ideas from anywhere they are, wherever they are, anywhere around the world. These are generally global companies playing into global marketplaces, and so where they may be located is really it's really a residual of that bottom up decision. So where we own On Running shoes because of they're fast growing, they're the world's fastest growing running shoe company. That's the exposure that you see in Switzerland. It really doesn't have anything to do with Switzerland itself. It's more of a play on their fast growing apparel brand. And that's the same thing that you see in Japan, where we own the likes of Sony and Fanuc. Those are plays on semiconductors and industrial robotics, and not so much on the local Japanese economics. On the next slide, on the sector allocation, so we have a very active approach, as Tony mentioned, and so we have been making changes through our sector allocation, through the sector allocation of the portfolio. I'd say the biggest changes that we've made this year are related to the macro environment, because the Fed, having been aggressive in raising interest rates last year, this year they've more or less reached the top of that mountain. And so this year we've been much more willing to reintroduce into the portfolio, companies that may have higher valuations that we were avoiding last year, but have the growth to justify that. And so in areas like technology and healthcare, those are areas where we've been closing our underweight this year. Meanwhile, we have been bringing down areas like consumer discretionary and energy, back more towards market weight levels. If you flip to the next slide, actually, I do want to spend some time on this on the next slide. It's our performance slide, because I really want to highlight for everybody in the audience what's different and unique about us. We're growth investors, but as you heard from Tony, we have an adaptive and flexible approach to growth. And that active approach means that we've been able to participate on both the upside and protect on the downside over the past 10 years. At the outset, Elvis mentioned how AGF Global Select has been the top performing global equity fund since 2013. And really the formula for that has been a 125% up capture ratio. What that means is that when the market's going up on average in the last 10 years, 10 plus years, we've captured 25% more of the market's upside. But we also have a 90% down capture ratio. So that means when the market's been going down on average in the past 10 years, we've had 10% less of its downside. Now, have we been able to do that? I think really the difference is in the philosophy and process that Tony outlined in the earlier slides, whereby we're trying to allocate to companies that are demonstrating growth because of innovation or sometimes because of the macro environment. And really a great example of that has been in the past 3 years. And so I want to turn your attention to the calendar year returns at the top of this page. So in 2020, you'll see that this portfolio returned over 42%. It outperformed by almost 30%. And that was because we were in a lot of those early COVID winners, right? What did well in 2020 when everyone was stuck at home were the companies that had the virtual products and services that allowed people to work from home, that allowed people to shop from home. So, companies like e-commerce companies like Amazon, but in addition to Amazon, we had the likes of Shopify. We had Mercado Libre, which is a big e-commerce player in Latin America. We had a company called Logitech in our portfolio, which many of you may have bought from, as you bought equipment for your home office. These are all companies that saw pull forward in demand in 2020. Now, I think what made us different is how we performed after that, because many growth investors also did very well in 2020. But the difference was that we didn't stay with many of those early COVID winners. And I think it really has to do with that white sheet of paper approach that Tony mentioned at the beginning, that daily test of objectivity. Because when it comes to a company like Logitech, Logitech doubled within 3 months at the outset of the pandemic. We had a company called C, which is a big e-commerce player in Southeast Asia, that tripled by August of that year. And so many of these companies, if you're asking the question, are you willing to buy those stocks today? Eventually, the answer became no, and so we began selling them down beginning in July of 2020 and throughout the second half of 2020. We went underweight in technology. We began building up overweights in areas like energy because we felt that the economy would reopen. And as we fast forward to 2021 and 2022, it turns out that energy was the area that was the best performing in those years. In 2022, last year, the Fed was aggressively raising interest rates. We had inflation. The markets saw a bear market, right? So the returns that you're seeing are in Canadian dollars. In US dollars, we saw the MSCI ACWI index down almost 20% last year. This Global Select protected on the downside. We outperformed by about 3% last year. And that was a very different environment than 2020. So if you compare 2020 and 2022, one was an up market, one was a down market, one was where growth-oriented managers did really well, another was where value managers did very well. We were able to outperform in each one of those environments. And I think when you look back further in the track record of this strategy, you'll see that we've outperformed in 8 out of the last 10 calendar years since 2013. You'll notice the down years that we've had on the MSCI ACWI index, the benchmark. We've been able to outperform in each one of those years. Now, this year, we are underperforming a bit. You can see that we're trailing the index a bit. The reason why is really due to what Tony spoke about earlier. It's been a very narrowly led market, particularly in the first half of the year, where we saw nearly all of the U.S. market return and most of the global equity market return attributable to those 7 stocks that Tony mentioned, those magnificent 7 stocks. And so the reality of not owning the majority of those stocks, that was a very big headwind for us. Now, the good news is that narrow leadership does not last. We've seen a broadening out of market participation, whereby more stocks have participated. So I'm happy to report that in the past 6 months, since the end of May, we have outperformed. This portfolio has actually been a top quartile performer in the last 6 months. We've come out very strong in October and November, and we're back to outperforming, over the last 6 months. Now, if you look at the American Growth Fund, that's actually, if you flip to the next slide just shows how we are. If you go back one slide, sorry, Elvis. This slide just shows these are all of the funds in Canada's global equity category with a Series A or Series MF series with a performance history that dates back to May 1st, 2013. And you can see actually Global Select is at the top of the list. It's also at the top of the list by not a small margin. It's by quite a fairly comfortable margin over the second and third place funds. Now, if you flip to the next slide, and I'll just touch on the American Fund quickly before I pass it back over to Tony. This is our flagship fund. It's the fund for which we derive our firm's initials from. It's also it's also the one with the most assets in terms of the mandates that we manage. So, to the extent that you prefer some exposure in your portfolio solely of U.S. large caps without the international exposure, this is a great candidate. It's also been one of the top performing U.S. equity funds during Tony's tenure, and it's a very similar story to Global Select. When you look at our sector allocation, this is also an area where we've been rebuilding areas like technology, like in healthcare. And if you flip to the next slide, you'll see that there is overlap with Global Select. Some of the similar names that Tony talked about: Amazon, Eli Lilly, Nvidia, Palo Alto in cybersecurity. These are all innovative companies that we found to populate this portfolio. And if you flip to the next slide, on the performance slide, it's a very similar story on performance here, except the one thing is that there's an even bigger percentage of the U.S. market return this year is attributable to the Magnificent Seven. So not owning the majority of the Magnificent Seven is 145% of our relative underperformance in this particular portfolio this year. So 145% means that we've actually outperformed in the other 493 stocks by about 300 basis points. Now, that just hasn't been enough to offset the huge headwind from the first half of the year from not owning those 7 names. The good news is that that's turning around. We've been coming back very strong. This portfolio is up 11% in the last 6 months. It's top decile in the U.S. equity category in the last 6 months. It's now up 13% on the year now. You can see how much that's changed from the end of October till today. So we're gaining ground fast. We're back to the historical track record of outperformance. And, we're very comfortable in terms of how the portfolio is positioned today. So with that, I'll pass it back over to Tony, and I would be happy to join him with taking any questions that might come on afterwards.
Thank you, Jonathan. So we appreciate everybody hanging in on our talk this afternoon, rather. We're happy to entertain any questions, and then I can just give some concluding remarks. But Elvis, Robert, anything that you want to fire our way? Sorry that we may have gone on a little bit longer, and getting into the Q&A period, so I apologize for that.
No problem, Tony and Jonathan. Extremely informative presentation there. Loved the points you made. I think you've covered a lot of ground in terms of the questions I had ready for you, but here are a couple. So the melt up we've seen in this month, S&P up almost 9%, TSX up about 7%, kind of reminds me of 3 years ago when the markets just went crazy, thanks to the rapid discovery of the COVID vaccines, like you mentioned. do you think this is setting us up for a rough 2024 on the expectation that the market seems to be expecting that a soft landing or a shallow recession is very much on the cards? Do you think that's being a little too optimistic?
So you make some very good points, Elvis, that in fact we've had a very sharp run up here in November. It happened to coincide with the seasonality aspect where the market does tend to go up between November and the end of April at a more significant pace than it does in the period from May through the end of October. That's why it's known as sell in May and go away. Mm-hmm. But also happened to coincide with the aspect that central banks, the Federal Reserve, Bank of Canada, have been feeling that perhaps they need to pause on interest rate increases. And I think why the market's moving up and why, Jonathan's comment of the broadening out of the stock market is taking place is because once we go through this period of a slowing down of the economy, perhaps with the holiday period early next year, that the market is not a lagging indicator, it's a leading indicator. And I think that by the time, we may be fortunate enough to talk to you and your clients once again, we could be talking about more of a global synchronized economic recovery. And as I mentioned earlier, once you get the economy being in better shape, then profits will continue to have their recovery, and that's going to be encouraging for the stock market investor. But you make a good point. Nothing goes up in a straight line fashion. We could pause, and I would say that any setbacks are buying opportunities, and I would not get. I'm not too concerned about the market perhaps digesting some of the recent gains because, as you said, they have been sharp and to the upside.
Great points, Tony. Thank you. Next question is, thanks to the introduction of AI, does that give the US like a sustainable competitive advantage for the next little while that continues to make it the only game in town? And I mentioned this because a couple of weeks ago, we took down a Canadian allocation in our portfolios a little bit, allocated that to the US. But the US has been on such a strong run for the last 4 or 5 years. Do you see this outperformance continuing over Canada and the rest of the world in the next 2 or 3 years? Or do you see that differential narrowing and perhaps even going the other way?
So I'm not sure about the next 2 or 3 years. When it comes to the valuation aspect, if you look at a company like Microsoft, a company like Apple, each of these companies is worth more than the UK stock market. Imagine that. One company has got, each company is worth more than the UK stock market. They are selling at about 30 times and 36 times. UK market sells at 12 times. In fact, the Magnificent Seven, further to Jonathan's point, they've gone up so much that the appreciation exceeds the entire market cap of the Canadian stock market on a year-to-date basis. So what we also know is that the valuation on a 12-month period is not so important. What's important is, are the companies delivering results? Are the results encouraging? Are they to the upside vis-a-vis expectations? So we expect that U.S. companies are in better shape to meet and exceed consensus estimates. And so for the time being, we're going to invest in those companies, whether they're in the U.S., internationally, and elsewhere. But I do agree with you, Elvis, that looking out 2 or 3 years, looking beyond North American borders could be more promising. But I think that may be a premature step at this point.
Thank you, Tony. Jonathan, a question for you. You alluded to the pivot that your team, you and Tony and the team made around, back in 2020, when you saw what was coming and you kind of shifted the portfolio around. What were the factors that enabled you to make, I know that the global fund has a pretty high kind of rate of turnover. What are the factors that enable you to get the jump on the competition, so to speak?
So I think, what made us different than the competition was really not sticking with the same stocks because, the stocks that did the best in 2020 were also the same stocks that did the worst in 2022. And we know, from the news media, many of the heroes that were in 2020 turned out to be, turned out to be not so hot in last year.
Mm-hmm.
And really, I think for us, it really has to do with that that flexible approach and that idea of objectivity. I was trying to give a few examples earlier about how the idea of objectivity would apply when you have such an enormous run off the bottom, like we had in March of 2020. We had a 35% drop in 1 month in March of 2020. Then we had an enormous recovery, and it was really led by some of these these companies with virtual products and services. If you recall back to that time, people were logging into Zoom calls for the first time ever. Zoom we had in our American growth portfolio that went from 10 million active users to 200 in a couple months. The stock price went up 6 times in a couple months. People were lining up for Costco for toilet paper. I didn't really understand that ever, but that was the case. And, we had that in the portfolio at the time. But I think if you're ultimately, asking yourself the question every day, are you willing to buy Zoom today? I think eventually the answer became no. So that was a trigger in terms of ultimately selling down many of those early COVID winners.
So Albert, trees don't grow to the sky.
Yeah.
And we were feeling that at some point there was going to be light at the end of the tunnel of reopening the economy, and that everything that was turbo boosted from the pandemic was going to last only so long. Now, many of these companies have not come back. If you look at DocuSign, if you look at Zoom, if you look at Teladocs, the telehealth medicine company that we also had owned, they're nowhere near, where the run that they had. So we take this aspect of leadership always changing, and we didn't think that that leadership was going to stay in its current mode that benefited from the shutdown economy for a prolonged period of time, even though the results were terrific when for the companies reporting great results in terms of profits and earnings. But, we have to look at the other side, and I'm glad that we did.
Tony, I've got a couple of questions, and then we can wrap it up. You alluded to the credit losses that a couple of the Canadian banks that reported, I think Scotiabank and TD Bank. What's your take on how the Canadian economy is positioned for the next year?
I'm not so optimistic in the near term for Canadian economy because interest rates are much more impactful here than they are in the U.S. If you look at the U.S. consumer and the balance sheet, ever since the global financial crisis in 08-09, U.S. consumers have been paying down debt. Their debt to disposable income has come down, and Canada just continues to go up. And so the fact that interest rates had to be raised to bring inflation under control is going to be much more impactful here. I'm also a little concerned about the spending coming from Ottawa and the fact that it's not as efficient as it perhaps could be for aspects that are going to allow for Canadian economy to be, more productive. That said, at some point, the more economic cyclical areas of Canada are going to be interesting. Whether it's going to be in the energy and the materials, these are going to be interesting, but it's too early now because they typically do well when the economy is in unison and looking to the upside, but we're not there. So the banks have a good yield. They're conservatively managed. They may be a buy for some investors, but they're not a buy for me.
Thanks, Tony. Jonathan, a question for you. Does currency or currency moves, do they play a role in your investment decision making?
Generally not. I think with currencies, we have the ability to hedge currencies, but we've typically have not done so. But I think when it comes to companies reporting results, in terms of any kind of currency impact, generally speaking, that investors tend to look through that, tend to look through any kind of because it's seen as temporary. So generally, currency swings, they don't really impact the way the portfolio is managed.
Thanks, Jonathan. Final question. Tony, any thoughts on inflation? Do you think we can get down to 2% at any point?
Inflation is coming down faster than I thought. I somehow think that inflation is going to be tolerated at even if we get down to less than 2%. I think it'll be temporary, but I think we can tolerate inflation that may be less than 3%, but not consistently below 2%, because the cost of the economy of getting it down to below 2% on a more consistent ongoing basis for this decade, I think is going to be too onerous, and that I think that the central bank and politicians should recognize that, and that hopefully the policies will reflect it.
Terrific. Fantastic. Thank you so much for answering so many questions, Tony and Jonathan. Any concluding thoughts?
Well, this decade, as I mentioned, has been full of ups and downs. And through those ups and downs in the economy, in the stock market, 2 bear markets in less than 4 years, that doesn't usually happen. And yet, if we look at the return from January 2020 through to today, we're up almost 10% in terms of a U.S. stock market return. Maybe the world index a little bit less than that. If you look at me managing the namesake product of AGF, the American Growth Fund, which has been around for 67 years, almost as long as the Maple Leafs have won the Stanley Cup. I don't know about the Canucks. I have to look it up. When did they win? But it's been a long time. I think Canadian team haven't won since 1993. Anyway, almost 11% return. So, what I suggest here is that stay invested. The waters could be choppy, but with the Luft team being the rudder on your hard-earned assets, arriving in the right place, you are in very good hands, and we're happy to be part of any solution set that helps you to get to your objective. So thank you for having us on the call today.
Thank you, Tony, and thank you, Jonathan, for the ringing endorsement. Robert, over to you.
Yeah, thank you both so much for taking the time. I know it's late where you're zooming, teaming, videoing in from. So appreciate always both of your insights, and hopefully people find this really valuable. And we look forward to there'll be a replay available on our YouTube channel. And again, thank you, Tony and Jonathan, for being a big part of our Platinum Growth Fund that we help manage our clients' equity positions with. So without further ado, we'll let everybody go for the evening, and thank you very much for attending.